At 3 in the morning, while most of the world is asleep, trillions of dollars quietly change hands. No ringing bell, no flashing headlines, just lines of code talking to other lines of code in a market almost nobody ever sees. And yet, this market decides how expensive your mortgage is, how strong your currency feels, and sometimes whether an entire economy gets to breathe or choke. It's called the repo market, short for repurchase agreements, which already sounds boring enough to skip, but stay with me, because this is the hidden plumbing of global finance. And when plumbing fails, the house doesn't flood slowly, it explodes. Let's start with a simple story. Imagine you own a gold bar. I own cash. You need money for just one night. I need something safe to hold. So you hand me the gold bar, I hand you the cash, and tomorrow you buy your gold back for a tiny bit more. That tiny bit is my interest. That's a repo. Now scale that up from a gold bar to U.S. Treasury bonds, from one night to billions of dollars, from you and me to the biggest banks, hedge funds, and governments on Earth. Every day, roughly $4 to $5 trillion flows through this system. That's more than the GDP of most countries, and it happens mostly in the shadows. Why does this matter right now? Because in a world obsessed with stocks, crypto, and AI trading bots, the real heartbeat of finance still runs through this quiet, boring, overnight market. When it's calm, nobody notices. When it panics, everyone pays. Here's how it actually works. Big financial institutions constantly need cash to settle trades, to meet regulations, to make bets. Meanwhile, others are drowning in cash but want something safe in return. So they meet in the middle, swapping cash for government bonds, usually for just one day. The bonds act like a pawn shop ticket. If the borrower disappears, the lender keeps the bond. Simple, elegant, almost too simple. And that's where the hidden math starts to get uncomfortable. Because this system only works if everyone agrees that those bonds are safe enough. The moment trust cracks, even a little, the entire machine starts to stutter. In September 2019, something strange happened. Overnight interest rates in the repo market suddenly spiked from around 2% to nearly 10%. That's like your credit card bill quadrupling in a single day. Banks didn't trust each other enough to lend. Cash vanished. Panic crept in. The U.S. Federal Reserve had to step in and inject hundreds of billions of dollars just to keep things moving. Most people never heard about it. The stock market barely flinched. But behind the scenes, the financial system had just coughed hard. Then came 2020. When COVID hit, fear spread faster than any virus. Investors dumped everything for cash. Even U.S. Treasury bonds, the safest asset in the world, started behaving like hot potatoes. The repo market froze. The Fed didn't just inject billions this time. It unleashed trillions. Overnight, a financial fire hose pointed directly at a market most people don't even know exists. Here's the irony. We talk about banks as if they hold mountains of money. In reality, they run on confidence and short-term borrowing. The repo market is how they roll their debt forward, day after day, like a massive financial treadmill. As long as the treadmill moves, everything looks stable. The moment it slows, gravity takes over. And now, there's a new twist. Hedge funds have turned this boring market into a high-speed trading strategy. They borrow cash in the repo market at low rates, then use that cash to buy bonds that pay slightly more. The difference is profit. Tiny profit. But when you leverage it up 10 times, 20 times, 50 times, suddenly a fraction of a percent becomes millions. It's elegant, it's legal, and it's fragile. Because if rates spike or lenders pull back, those trades unwind all at once. Bonds get dumped, prices swing, and the shock ripples outward into stock markets, currencies, and pensions. This is where the hype and the reality part ways. The headlines talk about meme stocks and crypto cycles. The real leverage, the kind that can shake governments, often sits in this quiet, overnight market, humming along like a power plant nobody tours. Zoom out, and the picture gets bigger. The US dollar sits at the center of the global repo system. Foreign banks, governments, and funds all rely on access to dollar funding. When the system tightens, it's not just Wall Street that feels it. It's emerging markets, trade, energy prices, food costs. A hiccup in a New York money market can echo into a supermarket in another country. And here's the part that should make you pause. This entire system is built on the idea that someone, usually a central bank, will always be there to catch it if it falls. A silent promise, an invisible safety net. But safety nets change behavior. If you believe the floor will never disappear, how close do you walk to the edge? Every year, the repo market grows more complex, more automated, more intertwined with trading strategies that move at the speed of light. It's efficient, it's powerful, and it's increasingly opaque. So tonight, while the world sleeps and trillions of dollars quietly trade places for a few hours of borrowed trust, there's a question worth leaving open. Is this hidden market a masterpiece of modern finance, or a machine that only looks stable because nobody's watching closely enough?